options are probably one of the most misunderstood things in trading. And when you're swing trading, the hardest part isn't figuring out whether to buy a call or put. It's figuring out which contract to buy, how much time you need, and how much you're actually risking. So throughout this video, I'm gonna break down exactly how options work for swing traders. And then after we do all that, we're gonna put everything together and walk through a complete swing trade from beginning to end. So with that being said, let's get straight to it. So let's forget trading for a second. Imagine there's a house currently worth $300,000. You think that house is gonna become much more valuable over the next year, but instead of buying that entire house today, you make an agreement with the owner. So you pay them a fee right now, and in exchange, they give you the right to buy that house for $300,000 anytime before a certain date. Now imagine 6 months later, that house is now worth $400,000, but your previous agreement still gives you the right to buy it for $300,000. So right now you have the ability to buy something for $300,000 that the market currently values at $400,000. And I explained all that to say that's the basic idea behind an option. An option buyer has the right, but not the obligation to buy or sell. But if the contract becomes worthless, you can pretty much let it expire. Now let's bring this back to stocks. Let's just say Apple is trading at $100, and I think Apple is going higher. So I basically have two choices. I could buy Apple shares or call option on Apple. So if I buy shares, I own shares. But if I buy a call option, I own a contract giving me certain rights involving those shares. That's the first distinction I need you guys to understand. So when you open up an options chain, and maybe you see a contract priced at, let's just say $2, new traders would think, oh, great, this option costs $2. But not necessarily. One contract generally represents 100 shares. So a premium of $2 would generally mean $200 for one standard contract. So pretty much $1 premium equals 100, $2 premium equals 200, $5. You guys get the point. Now, you can only trade two type of options, and that's call and puts. So a call gives you the right to buy the underlying shares at the strike price before expiration. Now, does buying a call mean you actually want 100 shares? Not necessarily. And this is another misconception beginners have. A lot of option traders never exercise the contract themselves. They may simply sell the option contract back into the market before expiration if it has increased in value. But just think about it like a concert ticket. Let's just say you buy a ticket for 100, the concert sells out, now people are willing to pay 300 for that ticket. You don't have to attend the concert to benefit. You could just sell the ticket. So when I'm buying a call for a swing trade, I'm usually focused on how the value of the contract changes as the stock moves, not necessarily on exercising it and owning 100 shares. Now, a put is the opposite side. So a put gives you the right to sell the shares at the strike price before expiration. So for a beginner, the easiest way to remember this is call equals generally bullish and a put means generally bearish. But I don't want you to oversimplify it into stock goes up equals call automatically profits and stock goes down, which means put automatically profits. Because very soon I'm gonna show you guys why that's not true at all. And this is where I break down three terms that I call in the money, at the money, and out of the money. Now for this, let's just say we're playing Nike, all right? For calls, a strike below the current stock price is generally considered in the money. So a $35 call is in the money, a $40 call is in the money as well. A strike around the current market price is generally considered at the money. Now puts work in the opposite direction. And here's where beginners usually mess up. They notice that out of the money contracts are cheaper. And let's talk about why. So you look at two calls with the same expiration. So the $95 call might cost several $100s, and the $120 call might cost a tiny fraction of that. And like I said, beginners immediately think, why would I spend all that money on a $95 call when I can buy the $120 for nothing? And the answer to that is because you're buying very different things. So the $95 call already has value from the relationship between the stock price and the strike price. And the $120 call doesn't. For that $120 call to become valuable, the stock needs to make a much larger move, which leads me into expiration. Every option has an expiration. So let's just say today is Monday, you buy a call expiring this Friday. You're not just saying, I think the stock goes up. What you're really saying is, I need this trade to work within 5 days. So imagine you think Tesla is gonna go from 330 to 350, and then 3 weeks later, Tesla reaches 350. You were right about the stock and wrong about the timing. This is why I think expiration is one of the most important concepts for swing traders, because we're really holding these trades overnight, maybe several days, maybe several weeks, and the trade needs enough time to actually play out. Now, that doesn't mean always buy as much time as possible, because more time usually costs more. And a quick side note before we keep going, if you're brand new to options for swing trading in general, I actually have a free course inside my Discord that walks through the basics step by step. I made it because I know how overwhelming all of this could feel when you're trying to learn everything from one video. So if you want something a little more structured that you can go through at your own pace, I'll leave the Discord link below. Now, this is where I need to make an important distinction. A break-even expiration does not mean the stock must reach that price before you can ever sell for profit. The option still has extrinsic value. So your contract could potentially increase before the stock reaches the expiration. And that's a really important beginner concept, because people look at break even and think, oh, the stock has to reach this exact price before I make money. And if you've been trading, you know that's completely wrong. Now we're finally getting into the Greeks. And here's what I want you guys to understand before I explain any of them. Greeks are not signals. They're trying to describe how the value of an option could respond to different variables. So a lot of people will confuse things and make it overcomplicated. But the first ones I want you guys to understand in today's video is delta, theta, and then we can get into gamma after we discuss those. So let's start with delta. So let's just say a call has a delta of 60 cents. One way to interpret that is if the stock moves $1 higher, the options price can go up by roughly 60 cents. So delta itself can change, but delta helps you understand how responsive your contract is to the movement of the stock. So let's compare two calls. Call A, delta is 70 cents. Call B is 20 cents. So if the stock rises $1, let's just say, call A is generally going to move more and faster than call B. And this is one reason far out of the money contracts can feel super frustrating, because the stock moves in your direction, but your option barely moves. And then time keeps passing, and suddenly that cheap contract doesn't feel so cheap anymore. Now we can get into theta. Theta is associated with time. So again, keeping it simple, every day that passes, there's less time remaining for the option to benefit from a move. Now, this doesn't mean your option loses exactly the theta amount every single day. Theta helps you pretty much understand your exposure to time passing, because sometimes your stock does absolutely nothing and you're looking at the chart thinking, I'm basically at the same price I entered. Why is my contract going down? Well, there goes your answer. Which leads to vega. Let's just say you have an option with relatively high vega, implied volatility increases, and your option may gain value from that volatility, assuming the other inputs stay the same, but then the implied volatility falls. So your option may lose value from that change. So again, I'm not asking you to memorize the exact calculations, because as a beginner, I want you to understand the relationship. So to simplify everything, delta equals the stock movement, theta equals time, and vega equals implied volatility. So once you understand those three, options start making more sense. Now let's actually open up an option chain. So you'll see two prices. You'll see bid, and then you'll see ask on the right. And the bid is what buyers are currently offering, and the ask is what sellers are asking. This is why liquidity matters. I don't only care whether I was right about the stock, I need to be able to enter and exit the contract with enough buyers / sellers, aka value. So another thing you'll also see, like I just said, value and open interest. So value tells you how many contracts have traded during that current session, and open interest reflects the number of outstanding open contracts. So for a beginner, you don't need to turn this into some secret indicator. I'm mainly using this information alongside the spread to understand whether there's activity in the contract, because finding the perfect option means nothing if the contract barely trades and you can't get it to fill. So again, boring stuff. I know it's boring, but this is the stuff that matters when you actually place a trade. Now that you understand what an option actually is, here's where I think people get the process backwards. So they open Robinhood, they go straight to the option chain and start searching for cheap calls. I personally don't do that. I start with the stock first. So let's pull up the chart. So first thing I ask is, what's the trend? Maybe we're making higher highs, higher lows, and then now price starts pulling back. So this is where I would identify an area where buyers previously stepped in. Now, do I buy a call immediately? Obviously not. I want to see price come into this area. So then I ask from here, where could this realistically go? How long could this trade take? And only after I answer those questions do I look at options. So let's just say I'm trading ONDS and my target is 15 plus. And I believe the swing can take several days or even longer. Now I'm looking at the expiration. Do I want an option expiring tomorrow? Probably not if the setup needs more time. And then from there, that's when I start looking at strikes. So maybe I compare the $8 strike, $9 strike, and I'm looking at what each contract costs. So it's delta, it's liquidity, and then I'm asking, does this contract actually make sense for the move I'm expecting? Maybe the $11 call is super cheap, but if my target is only 15 plus, why am I choosing a contract that needs a huge move within a short period of time? And that's the kind of logic I want you guys using after you finish this entire video. So always start from the trade, and then after that, that's when you choose the contract. And I'm about to list the mistakes that most people go through when they first start trading options, and I'll list them in order so we don't waste time. Number one, don't buy a contract simply because it's cheap. That's stupid. Number two, don't ignore expiration. 3, don't hold through events like earnings without understanding implied volatility. Next is don't ignore liquidity. And the last is please don't look at options as a way to rescue a tiny account. That's probably the worst mindset you can bring into this, because if you're trying to turn, let's just say $200 into 20,000, you're naturally going to be attracted to the contracts with the most extreme leverage. And usually the most extreme risk leads to people being broke. So hopefully after watching this, options feel a lot less complicated than they did before. Now, if you want to keep learning, I do have a swing trading course inside the Discord. It goes deeper into the foundation, how I look at charts, how I find setups, risk management, and the overall process of how I find my swing trades. So if that sounds useful to you, I'll leave the link below. Other than that, if this video helps you understand options a little better, like and subscribe. And if you guys want part 2, let me know in the comments below. I appreciate you guys for watching, and I'll see you in the next one.